Hello, everyone, and welcome to Investing by the Books, a podcast by Redeye. I'm your host, Eddie Palmgren, and next to me here in the studio is my friend and colleague, Niklas. How are you today?
I'm really good today.
Me too, and I'm excited because today we have the great pleasure of speaking with Mark Mahaney, who calls himself Wall Street's oldest and longest-lasting technology analyst. For 25 years, he has tracked and talked to the best technology firms, making thousands of stock calls. And Mark is the author of Nothing But Net, which was published in October 2021 by McGraw-Hill. Why have we chosen this book?
So at Redeye, we specialize in tech and life science companies, and I'm covering technology stocks as an analyst. So, I find Mark's book highly relevant for myself, both as an analyst, but also as an investor, which I think is really important for our listeners. We also want to thank our listener and Twitter follower, Renee Selman, who encouraged us to select Nothing But Net for the podcast.
And how does the book fit with Redeye's quality rating?
So Nothing But Net summarizes Mark Mahaney's top 10 lessons from his experience of covering tech stocks, and many of the lessons overlap with our checklist to determine the quality of a business. The book has specific chapters on the importance of product innovation, total addressable market or TAM, and value proposition, which are all included as checklist questions in our business rating. And parts of our people category are represented by the chapter on management. And in the end, our third pillar, financials, is visible in Mark's chapter named Revenue Matters More Than Anything.
We are excited to have the author of Nothing But Net on the show to increase our knowledge of successful tech investing. Here comes our conversation with Mark Mahaney. So hello, Mark, and welcome to Investing by the Books podcast.
It's good to be here. Thanks for inviting me.
So where are you today?
I'm in San Francisco today in my home office.
Nice. And to begin, how did your passion for investing start?
I was first interested in investing because I was first interested in this internet sector. I was on college campuses in 1996 when the first browsers or web directories, things like Yahoo and Excite, came out. I thought it was fascinating. There was a service way back then called Pointcast, which almost offered like real-time news. If you downloaded the app every time you went into the computer center, I thought that was great. I tried out this thing called Amazon at the time. Then I was in business school when this report came out called the Internet Report by a famed sell-side analyst named Mary Meeker. And I remember bicycling to the Barnes & Noble in downtown Philadelphia to buy that report. So there's a lot of irony in that statement, but it's true. And I worked in management consulting around the internet sector for a year or two, but then Mary's associate left to go to work at Amazon. Is still there 25 years later. He's done phenomenally well. I'm very happy for him. And I got a chance to work with her. So that's what really brought me to investing. I was particularly interested in the internet sector, and I decided I really wanted to get to the financial epicenter, the Wall Street epicenter of the internet. I thought that was working with Mary Meeker at Morgan Stanley, and I did that for 5 years, and it was a fascinating experience.
And now over the last 25 years, you've seen the birth and growth of this entirely new industry that has become the most valuable in the world. And during this time, you have met the leaders of the most innovative and successful tech companies, and also the best investors. So we are curious if there are any epic moments that stand out for you.
Well, let's see. I very much appreciating getting to know a little bit Jeff Bezos over the years in small investor group meetings. Here's a person with boundless energy, extremely intelligent and truly passionate about his business. So that was one of the encounters with him were extremely memorable. There were just one-offs here or there. This guy named Mark Cuban, who helped found this company called Broadcast.com and then sold it to Yahoo. And then I think at just about the peak of the dot-com bubble in 2000, 2001. And then I think took his position and collared it in a way that even though Yahoo stock price fell dramatically, he didn't lose any of those gains. And now he's the successful sports owner the Dallas Mavericks basketball team, and he's on Shark Tank. So it was fun being around him at the very beginning. And then along the way, just meeting and getting to meet some of the other entrepreneurs. I've really enjoyed chatting with investors along the way. Those investors that are still in the business that I've worked with, because they invested early on in some of these names. It's been great to celebrate their successes and talk through ideas with them. People like Bill Miller, who was at Legg Mason for many years, very early bull on Amazon and correct bull on Amazon, although he went through a lot of volatility with that stock for a couple of years there. So those are some of the memories that come to mind. It's the entrepreneurs and the long-term investors who've been very successful with this. In the book, I refer to some calls I had with Peter Lynch. Some of you will remember. Some of your listeners will remember him. He was he is an investment guru, worked at Fidelity, ran their largest fund, and then published a couple of books, one of which was One Up on Wall Street. That book actually was one of the inspirations for me writing my book. And one of my favorite moments was getting a phone call out of the blue from Peter Lynch back in roughly 2010. He wanted to talk about Groupon, one of the stocks I covered. So that to me was just, one of the greatest portfolio managers of all time wanted to call me, talk about internet stocks. So it was just a riveting 30 minutes, and his style of just question, and digging deeper into the details of potential investment was just fascinating to be a part of the process of. So those are some of my favorite moments.
Wow, I'm envious of many of those encounters. Reading your book, it's filled with stories about companies that have been successful and not so successful. But I want to first ask, what led you to actually write the book?
I enjoy writing. That's true. That's true. And I wanted to sort of there's a little bit of memoir in there, as you know from having read it. I enjoyed recalling the stories, recalling the stock calls I made, the good and the bad, recalling some of the people I met. Part of it was I wanted to just have something like I wanted to write down my story of the internet. And then I also, though, wanted to step back and say, I've covered this sector for 25 years. Peter Lynch wrote a wonderful book that helped Main Street investors invest. And I wanted to do the same thing, except for investors looking at growth tech stocks. And by the way, that's pretty much what Peter Lynch do. He didn't say that it's not in the title of his book, but he's really focused. His focus was always on finding high quality, high growth companies. High growth companies at reasonable valuations, high quality, high growth at reasonable valuations. And I kind of do the same thing. I don't focus on. I never have focused on energy stocks, airline industry, dividend-paying stocks. I've really just focused on that corner of the market, but I think it's a really important one for all investors to have at least some exposure to, which is high growth, tech stocks. And so that's what it was. It was the desire to kind of look back and retell some of the stories that I lived through. And then the desire to kind of share that wisdom and to not just share it, but also writing a book forces you to try to distill what you think are the most important lessons. And I came up with 10 that I try to apply going forwards, and I already have this year. We can go into it later, but I downgraded Netflix at the beginning of the year, even though it was one of the highlighted stories of my book, and it was a phenomenal stock for a decade. But I put in that book, when you should sell, and I saw one of those trip actions with Netflix, so I downgraded the stock. Essentially the equivalent of selling the stock. So I used the book as a great way to come up with a framework for how to think about stocks, and I practice what I preach.
And one really interesting term that you use for when to buy these quality stocks is dislocated high quality. I'm curious to know more about that, of course.
There's one punchline from the book that I hope people can remember, that I want people to most remember. It's DHQ. Now, if you go on the internet and you search DHQ, I think you'll also see that stands for Dance Hall Queen. That's not what I'm asking people to remember. I'm asking them to remember dislocated high quality. There's the other one is buy low, sell high. Well, okay, yeah, that sounds good too. But what I'm saying is buy low, high quality companies. So I think as a fundamental analyst, and I think that's, I want to step back here. One of the biggest, less simple, brain dead lessons that I've learned over the last 25 years is that fundamentals matter. Stocks can get dislocated from fundamentals for a period of time for a variety of reasons, market turbulence, misunderstanding of companies, et cetera. But, over the long term, the stronger the fundamentals, the better the stock price. That doesn't always work, but gosh, it works most of the times. I haven't found a case where a stock materially outperformed for a substantial period of time, like over a year, that didn't have improved fundamentals. I've seen some companies out. I think, for a quarter, sure, I've seen that, and even 6 months or something like that. But generally, I find that the stocks follow fundamentals. So what I try to do as a stock picker is I want to first focus on what I want to try to find the highest quality companies I can find. And I laid out these 4 factors that I screen for: companies that are addressing large markets, or TAMs, total addressable markets, companies that have got great have got a track record or evidence of great product development. If you're looking at tech in high growth areas, so much of it depends on innovation in the space, new product, new service innovation. So you're looking for high levels of product innovation. And I really follow consumer tech. My point in the book was you and I can all come up with reasons. We can do our own due diligence just as well as any sell-side analyst or buy-side analyst can on a consumer tech company, because we can use it ourselves and decide whether the product or the service is getting better or worse over time. Then I look at the third thing I look for: companies with really compelling consumer value propositions. And one of the best ways to really prove that is whether a company has pricing power or not. Netflix showed that they had that in spades for a decade, and that's why their fundamentals got better and their stock got better. And the fourth thing I look for is just really good management teams. I really like founder-led companies, and there's a lot of art in determining what a really good management team is. Well, I look for consistency in a management team. I do like when the founders stick around, and then you look for that evidence. Do they show that they can succeed in multiple different areas or verticals? And that was kind of one of the lessons for me on Amazon. And if I just double click on this just for a second, it's, Amazon was this purely speculative long from 1997 until, I don't know when, 2006, 2007, 2008, somewhere in there, it should have become a core long. And it should have become a core long because they showed that they could expand from book retailing online to multiple different retail categories online, and then to rolling out this thing called cloud computing or Amazon Web Services, and then launching this Kindle, this ebook reader. Like, those are very different markets. And when they showed they could succeed in very different markets, it should have been a tell that with this management team, there's something special about them, and they can probably continue to innovate in the future. So anyway, I look for those 4 things: management, market opportunity, level of product innovation, and compelling customer value propositions. I try to find those high quality companies, and then I just wait for them to sell off, and then I add to positions or start positions in those names. So that's, I wait for them to get dislocated, because my history of looking at these stocks for a quarter century is all of them get dislocated from time to time. Heck, we're living through a major dislocation opportunity in the market in the first half of this year. We lived through it in the first half of 2020 because of COVID. And there's been multiple times when high quality assets will sell off aggressively, 20 or 30% or even more, even though it's a high quality asset, or you think it is. And that's when you use that as an opportunity to really generate material income.
So one important factor in your book is revenue, and you have a chapter called Revenue Matters More Than Anything. And our interpretation from your book is that we should invest in companies that can consistently post this premium growth, 20% plus, which comes from a big base as well. And this is almost irrespective of short-term profitability. So the question is, how do you judge a company's prospects for long-term profitability and avoid investing in companies that sell $1 for 50 cents and are unlikely to ever be profitable?
Well, you state the question right. Now that's It's usually, people selling dollars for 90 cents, selling dollars for 50 cents. Now that's challenging. And so selling it for 90 cents. I actually haven't seen companies do that. So just so we're clear about that. And I guess I've also, one of the other lessons I've learned, like I've looked at some of these business models. I mean, I had one of the top portfolio managers in the country, or maybe in the world, stop me in the elevator banks at Morgan Stanley back in 2000, and putting his finger in my chest and saying, Amazon's never going to be profitable. I mean, he had to be right. I mean, given all the success he had, and yet he wasn't. And I didn't know any better. But as I followed it, I guess one of the lessons I've learned is that scale solves just about everything. You do consistent premium revenue growth for a long period of time, and you will scale against those fixed costs. And unless your variable cost structure is really upside down, if you really are selling dollars for 95 cents or 90 cents or 50 cents, okay, as long as you're not doing that, revenue growth can kind of solve most business model challenges. And I talk about Uber in the book, and Uber was sort of a work in progress when I wrote the book, and I sort of thought that they would have enough scale to turn profitable. I didn't know, but I thought they would, for a variety of reasons I go into in the book. And sure enough, here we are with more scale now that they finally worked through COVID, and they're running at bookings levels above where they were pre-pandemic. They're profitable. They just generated their first free cash flow quarter ever, and I thought that would happen, and I guessed it would happen, and it just to me, it's one more piece of lesson that you can invest in unprofitable companies on the belief that they will be profitable one day if you're confident that they can sustain, strong premium revenue growth.
And in the book, you also describe that many companies, and you mentioned Amazon now, and also in the book, you mentioned them as an example, and that during the dot-com bust, they really had to reduce almost all of their growth investments. So how do you think about that now? Is there like a similarity with this current market climate in your view?
Eddie, that's a great question. The number of companies, I just was on a call this morning with a small company called Warby Parker, which is a eyeglass retailer online and offline. And they, just like many other companies that I've listened to, they've been all in the mighty Google and Amazon too, and Spotify too. They've all talked about paring down their expense growth or cutting expenses during this period of time. And so what I tried to do, and I've seen companies go through different cycles doing this. So yes, you don't want to be buying stocks when you go into a recession, but you do want to be looking potentially at buying stocks that come out of the recession having optimized their cost structure. And if they've got new growth initiatives, that'll start kicking in, post the cycle. So that's, sometimes, the recessions aren't a good thing, but if they force companies to be more rational with their costs, I think Airbnb is a great example of this. I think the COVID crisis, they had to do a 25% workforce reduction, and they actually ended up being the most resilient of all travel names. And it made you wonder, well, maybe they were overstaffed to begin with. I think that in fact is true. And but because of that forced cost rationalization, they're actually going to be the best growth, top line growth, and the best bottom line growth company in online travel. I don't know that would have been the case if they had been forced to take down their cost structure because of the COVID crisis.
So I want to dig a bit deeper into this 20% hurdle that you mentioned. We have a lot of value investors listening to this podcast, and also growth investors. And I just want to know, is this 20% hurdle something you have seen that growth investors typically use as kind of a, I mean, if it goes under, then they just sell off? Or how do you think about that?
I want to make 2 points about 20% growth. One is that it's rare. And I mean it from scale too. Like I don't mean 20% growth if you have 100 million revenue base. I mean 20% growth if you're doing a couple billion in revenue. And so 20% growth, what's GDP growth worldwide? It's 2, 3, 4%. So 20% growth that's impressive. I mean, you're growing 10 times to six to 10 times faster than the global economy, you must have something. You may just be purely lucky, but you probably tapped into an interesting growth opportunity. Maybe it's a secular growth opportunity. Maybe you're dramatically taking market share away from other people. But companies that can consistently grow at that rate from scale are rare. When we actually looked at the S&P 500 and screened for what percentage of them have grown 20% revenue growth for 2 years or more, at any one point in time, it's a single digit percentage. And that's S&P 500 companies. So that by definition, they're at scale. They're usually, you have to be relatively sizable in order to get into that index. So that, to me, it's the output, but it's an indicator, it's a marker that there's something different about this company, that either they're in a great market opportunity, they've got great product innovation, they're dramatically taking market share. So it's a tell for me of something special in the company. And again, I want to be careful about that. It's from scale. And then what I also noticed is, so that's the first thing, is that it's rare to see companies that can sustain that growth. And so because it's rare, you want to know why they're doing that, because there's something special. And then the second thing is the markets generally reward companies that do that. So, when we looked at those stocks of companies that consistently generate that growth, they generally, not always, but they generally outperform the market, and by a dramatic amount. We'll put the details in our book. So we did put some academic analysis in the book to kind of to show the rarity and the rarity and the value of premium growth. People refer to the scarcity value of growth. Yeah, I think that's. I think investors are generally willing to pay more for growth because it's scarce. So anyway, that's and then so that helps me find high quality companies. Doesn't mean you buy any stock that's got any company that's got that kind of growth. You do want to factor in valuation, but I guess what I'm saying is I'd rather lose money on high quality companies rather than low quality companies. And I think about it this way. I'm going to summarize my investing philosophy, and I may be wrong, but I'm going to summarize my investment philosophy this way. If we're investing in the markets, we're trying to mitigate two risks. We're trying to mitigate, you can't eliminate, but mitigate or reduce fundamentals risk and valuation risk. Fundamentals risk is a management team blows makes a mistake with a new product introduction, or they dramatically lose market share, or they don't handle their cost structure well. You reduce fundamentals risk by only investing in high quality assets, or trying to skew your portfolio to high quality assets. So that's how you mitigate fundamentals risk, reduce it, and then you reduce valuation risk, the risk that a multiple gets cut in half or gets cut in a third, something material, by waiting for stocks to get dislocated, waiting for them to trade below their growth rate on a PE basis, so a PEG or PE to growth ratio less than 1, or make it simple, just wait for a 20 to 30% correction in a stock, because even the highest quality names of the last decade, Apple, Microsoft, Google, Amazon, they've all had their 20% or much more corrections at some point in time, usually because of a market rollover, but sometimes because of company mistakes. So that's my approach. I'm trying to mitigate those two risks, and I do it by buying DHQs, not dance hall queens, but dislocated high quality companies.
And you mentioned management as one very important aspect, and you also said in the beginning you're meeting with Jeff Bezos, for example. So can you tell us a bit more what traits you are looking for?
This is very art, not science. But you want to see management teams that are consistently in place. Now, a bad management team in place for a long period of time, that's not a good thing. But you want to see companies with relatively low manager turnover. I'd love to see founders still running the company. I'm going to work backwards. So this isn't scientific. This is correlation, not causation. But if you look at the biggest tech companies by market cap, you'll find that they're pretty much all founder-led, or they've had founders in there for a decade or two. When I looked at the top tech companies, the average tenure of the chief executives of the founders was 20 years with the companies. So that's not scientific analysis, but there's sometimes we got to look at the data and the results and kind of rely on our gut instinct a little bit. I'm doing that this time here. So anyway, that's what I think about. I'm looking for consistency in management teams. I want to also I'm looking for a couple of tells. I've been around managements that are very focused on the quarter, and what would the street think if we did this? What would the street think if we did that? And my reaction is, why are you should be run your business, to maximize cash flows, to maximize revenue, to maximize profits and earnings in the long term. Don't focus on the near-term dynamics. When I hear management teams focused on the near-term dynamics, it's like, are you running your business for the 3-month Wall Street trading crowd, or you're running it for investors? I think you make more money if you're running it for investors. So that to me is a little bit of a negative tell when I hear managements talk about and seem to hyper focus on near-term.
And that's typically not the owner-operators types, or would you say?
Yes, you're right. Yeah, you're right.
It reminds us when we talked to Bethany McLean about Enron, and that when they have the stock price charts in the elevators and so on, it's not a good sign.
Did they really do that? I read that. It was a wonderful book. Did they really have stock? I forgot that. Stock charts in the elevators. Man, that's a great example of a company to avoid. I'd forgotten that. And I want to, here's your local example, by the way, in Stockholm. I really, Daniel Ek, I've met him twice and I barely know him. But I appreciate what seems very clear to me to be a long-term orientation. If you listen to him on all the earnings calls, and so I've listened to him now quarterly basis for 4 years or whatever. And so I've heard him, 16 times. And boy, what comes really clear in that is that he's got a long-term vision of the company. At the recent investor day, it's all up on the internet, on the Spotify investor relations site. You hear about a person talking about 3, 5, 10-year goals, how the company can change, how they can become an audio platform, not just a music platform, and how they're willing to invest. Now, the stock got punished earlier this year because they were willing to invest and bring down profitability this year. But the mistake I saw was with names like Yahoo and eBay early on in the internet run, where I saw those management team take up margins and underinvest in their business. A much greater mistake I've seen in terms of long-term shareholder value with companies underinvesting in their business rather than overinvesting. And I think if you look at the classic examples in my mind, Amazon versus eBay, overinvestor versus an underinvestor, and the company that overinvested did phenomenally better for shareholders, not necessarily in any one quarter, but over a multi-year period they did. That's what I'm looking for in management teams.
Let's dig a bit deeper into the people side of business. Having the best employees is often seen as an important advantage, but as you state in the book with examples such as eBay, popularity from employees for certain companies can change quickly. And Netflix is one company I thought about then, because they are famed for only employing the best and paying top dollar for that. Do you view this as a durable advantage for a business?
Well, I guess the answer is absolutely yes, that, having a really good employee base is a durable advantage. I'm not sure I have great insights into how management teams do that. So that's more of a corporate culture. I kind of see the output of it. It's very hard sometimes to know whether the companies have good HR policies. I know that Netflix is radical in their approach. There are there's no policy on vacation days. There's a wonderful book called The Netflix Rules that came out. It was probably it probably got a little excessively optimistic or positive about the culture of the company. But they did point out that, there's no rules on vacation. You can take vacation whenever you want. Now, if it undermines your productivity, okay, that you may be asked to leave at some point. So anyway, I'm not sure what the right approach is there. Yes, but absolutely, at the end of the day, the companies they're not inanimate objects. It's the management teams and the employee base that determine how well a company does. I do find that success breeds success. And so the more successful a company is, stock-wise, fundamentally, the better it draws people. I also remember a statement that Eric Schmidt made to me shortly after the Google IPO. And this is going to be a great example, I think, of the difference between a financial and an entrepreneurial mindset. So I was with a small group of investors with Eric after the IPO, and one of the investors said, "Hey, Eric, so now that the IPO is come and gone, how are you going to be able to, retain talent? Because all those, hotshot engineers that were looking for that big IPO pop, well, now they're going to go find the next new thing, the next hot IPO, and join them." And Eric's response was, "That's not the way engineers think. Like, they're looking for really great challenges, something that really finds them motivating, something that makes them want to do an all-night, hackathon." And so we actually find that our talent pool, our applicant base, the quality of our applicant base has actually improved materially since our IPO, because the word has gotten out about how challenging and how exciting the work opportunities are at Google. Anyway, I don't know whether he was just saying that and it was a bunch of BS, but the track records of Google since its IPOs and the talent pool that they built over time seems to suggest that he was right.
So speaking about advantages, the big tech companies, they're often praised for their strong competitive advantages, and that includes network effects, which is often named as maybe the most important one. But you write that network effects are overrated. So can you please expand a bit? Why do you think so?
Well, I may be overstating it. Obviously network effects are important. It's just that, Eddie, I had this burning example of eBay. You can go find some old research reports I wrote that I'm sure I praised them for their network effects. They had the most buyers, therefore they beget the most sellers, therefore there's more liquidity, there are more products on the site, which begets more buyers. Like, how could eBay possibly lose? Well, they lost because network effects are really important, but customer service is even more important, the customer experience. And Amazon ended up in the end having a lot more buyers and a lot more sellers. So network effects can give you a temporary advantage, but it's not a permanent advantage. And then I think about where else? Grubhub is an example of a company that should have benefited from network effects. More buyers, more restaurants, more which begets more buyers, etc. So there are network effects advantages. Uber has that. I think it's kind of hard to see somebody breaking. They're very strong local network effects. I'm sorry, that's another point, which is that you can have a really large driver fleet, whatever, in San Francisco and a lot of consumers there, but that means nothing to a consumer in Stockholm or in Miami or in London that needs a car service or wants a ride share. So the network effects can be highly local for some businesses. Anyway, it was really the eBay experience that made me kind of wonder just how network effects seemed, in my mind, hearing companies make a lot of pitches. A lot of companies make a lot of pitches over time. It seems like people leaned in a little too heavy on their network effects. And I just look for companies that really just provide an outstanding service to customers. And so there's a little quip in my book about customer value. Customer value beats business models. Look for great, compelling value propositions versus great business models. You can have a great business model like eBay did and Grubhub did. They were profitable. They were the profitable leaders of their segment. But they didn't have the best customer service, and they got displaced. And the market cap went to the companies with the better customer service.
And one way to expand that value proposition is to add another leg to your business. And at Redeye, we have a model portfolio, which we call our topics. And we have in recent years been given more appreciation to companies with optionalities to expand their business. And you mentioned, for example, Amazon's AWS as perhaps the best example in history of this. So what are your lessons on how to identify a company with optionality?
Well, I think this is relatively straightforward. It's companies that are investing in new growth initiatives. What are your other bets? Google has been very specific about it, and they've invested in Waymo, an alternative, not alternative, in driverless car technology. What are the other ones? Oh, Facebook's got a massive optionality. Now, options, of course, can expire worthless. That's why they're called options, and they can be worth a lot. But that's in the metaverse, and they give you wonderful disclosure around that. Amazon hasn't really broken it out, but I think Amazon has got a bunch of these kind of long-term investments, and they also do a lot of optionality on the cost side in drone delivery. But I think about business to business, logistics, office supplies, industrial supplies is kind of a little bit of the option value for Amazon. So yeah, when I talk with companies, what I want to hear them talk about is their core business and how they plan to continue to invest in it and grow it, for the next 1, 2, 3 years, and then and then I want to see that one extra slide. And oftentimes, when these companies go public or they have their investor deck, I want to see that one extra slide that says long-term strategic, plans or long-term strategic direction or option value. Like, what do you got? And it's fine if it's going to expire worthless, but here's your core business now. Where could you go in the future? And I understand that companies and management teams don't necessarily want to disclose everything, but just give us a sense of what you see as interesting new growth opportunities to go into beyond your core business.
And I want to go into a really nerdy question from that. As you state, very few internet companies manage to stay dominant over time. And I was just thinking, how is that converted into your DCF models you use to value these kind of companies? What kind of duration do you count with, and how do you think about that?
Well, you're right. It does seem like if I think about I guess I should do, if I were to go back and look at the largest market cap internet companies in 2001, I think Yahoo would be in there, AOL would be in there, and eBay would be in there. And Niklas, you're testing me here. I'm going to guess, and this is factual. We could Google it. I think those actually would be the 3 largest market cap companies back in 2000, 2001 would have been eBay, Yahoo, and AOL. I'm pretty certain that's right. If not, they're top 5. Somebody can check me on that. And where are they now? So yeah, the things can change. Now the market cap has actually been relatively consistent over the market cap leaders have been relatively consistent over the last couple of years. But that could change in 5 years. I can see TikTok emerging as one of the top 3 or 4 market cap names. I can also see Uber doing that too, just given how large the TAMs are. I think I went off on a tangent, and I think I forgot your question, but it had to do with the DCFs and the time and the length of time we look at. I generally try to have 10-year DCFs for all the companies that we cover.
That's interesting. I need to ask more about the TikTok example. I mean, I'm not using it, Ed is not using it, but we've heard younger colleagues who use it a lot, and really a lot. I mean, they spend hours and hours each day on TikTok. And many investors I hear just speak about that it's a Facebook killer. But when I thought about it, it's more or less it's an entertainment killer. I mean, what's the impact on Netflix? What's the impact on like online mobile gaming companies and Spotify and so on? How do you think about that?
Well, I think it has enormous implications for companies. So short form video has dramatically gained attention. And I forget where TikTok is, but there are over 1 billion users. And then when we look at the time spent per TikTok user per day, that's doubled. Like it's gone from like 40 prior to the pandemic. TikTok was around 40 minutes per user per day. Facebook was around 40 minutes per user per day. Instagram was there too. YouTube, I think YouTube was a little bit higher. Since then, TikTok's time spent per user per day has more than doubled. It's now 85 to 90 minutes. Facebook and Instagram are both, a little bit higher, like 45 minutes. I think off the top of my head, I think YouTube's closer to 70 minutes per user per day, but that stayed roughly flattish from where it was pre-pandemic. So TikTok, you can just see it in the numbers, the user numbers and the time spent per user. It has just dramatically increased its time. So where did that? So that's about a half an hour. Where did that go? That 30 minutes of time, that more that people spend with TikTok, where did that come from? And I assume that, I think a lot of it's kind of kill time entertainment. So it probably, in a way, took away from other sources of kill time entertainment, like television, like potentially social media, maybe YouTube. Although it doesn't really show up in the data, I think it's probably come away from some long form entertainment like Netflix and other streaming sites. I think they probably have been negatively impacted. So yeah, I try to track user trends and engagement trends, whether that's wallet shares or the amount of time people spend with an asset, or the amount of dollars or currency or euros they spend with an asset. And then when I see these, occasionally you see these things like Facebook. I remember watching those numbers go off the charts, 10 years ago. And I'm sort of seeing the same thing with TikTok now.
It's going to be very interesting to follow that development. And coming back to the book and your role as a sell-side analyst, it's not only me and Niklas who have read your book. Most and many of the analysts here at Redeye, they have also read your book, and we have many analysts around the world also listening to this podcast. So many analysts become money managers or start working operationally in a company, for example. So we're curious, what is it about the analyst role that you love? What have kept you in the business?
Well, I enjoy the analytical work of it. There's, I enjoy the quantification of it. It's like three parts of the job. It's the core analytical, creative analytical, and then the storytelling. How's that? Or communication, storytelling doesn't sound serious enough, although probably that's what it is. But anyway, so the core analyticals, I enjoy trying to find that certitude in an uncertain world. Like trying to come up with the exact revenue forecasts, what kind of earnings, putting together that 10-year DCF, and it's wonderful when numbers come out and you create numbers and knowing. So I enjoy the certainty. I enjoy the analytical rigor of that. The creative part of it, though, I enjoy just as much, which is, forget the spreadsheets. Like, how different could Amazon be in 5 years? What areas could they go into? Will autonomous vehicles really be successful? Like, some of these things are just it's hard to have good, hard answers to them. You have to step back and you have to be a bit of a psychologist. I don't know, a future determiner. Like what, ride sharing is right. What's going to happen to ride sharing when we get autonomous vehicles, or will we get autonomous vehicles? And is that going to be good for Uber? Or is it going to be bad for Uber? So I enjoy the creative side of that. If you have a position in a stock, you should be able, if you're creative, you should be able to if you're a bull on a stock, you should be able to articulate the bearish side of the stock just as well. There's that part of the job that I really enjoy. And then the third is I just enjoy the communications part. I do enjoy writing. I do enjoy talking about stocks. I much prefer discussing with clients rather than lecturing to clients. Out of the full knowledge that none of us knows the future. We all have made major stock picking errors in the past, and that makes the job exciting. If you got every call right, boy, it'd be boring. It's when you make the mistakes that you realize you've got more to learn. And if you didn't have more to learn, then what's the point of doing the job? So anyway, that's what those are the three things I kind of like about it: kind of the detailed, analytical, the core analytics, the creative analytics, and or the creative thinking, and then the communication of ideas.
And how many stocks do you cover, and how do you spend your time between those three different topics?
Well, it's probably about equal amongst those three things, and we cover about 40 stocks, 40 consumer internet names.
And you're a team of?
We're six, and seven. We're based in San Francisco. Although one of the associates working with me will be leaving in a month. He's having to relocate to Los Angeles. The poor guy, and he's got a great, wonderful opportunity with a buy side firm there. If you're going to be a long only investor, the single best buy side firm you could probably go to is the one that he's going to. So I'm super thrilled for him, which means we are looking to hire, but there is a qualification. You have to be willing to be based in San Francisco. I know that's a hard challenge for people, but we are looking to hire.
Good, spread the word. And I mean, from your book, it's clear that while you're an analyst, I mean, you think as an investor. What benefits do you think that brings?
Well, I guess it grounds you, because you can run through all the deepest analytics you want. Clients pay for, and clients appreciate a variety of things. They do appreciate deep analytics. They appreciate people who can pick stocks. They appreciate analysts who can help arrange introductions to companies. They appreciate analysts who can put together really good conferences or unique events. We're hosting a panel in a few weeks. I found 3 legal scholars that can talk about this Elon Musk Twitter case that's going to go in front of this Delaware judge. I mean, it's pretty esoteric about M&A litigation and what's the expression? There's some legal term for system processor. I forget what it is, which is exactly why I brought together these legal experts. So I created an event that would be buy-siders could do on their own, but I'm making it easier for them, and they may not know some of the experts I can tap into. Anyway, so ours is a client service job, and but I do think, having said all that, the more, at the end of the day, investors, if they have bad stock picks, they won't be clients of yours in the future because they'll be out of a job. And it's very clear that that side of the business. And so at the end of the day, all this stuff helps. But if I could specifically help a client, locate a stock that's going to go higher or lower if they're short the stock, then that's my grounding. At the end of the day, I want to create all of these events. I want to provide great client service. I want to provide all the flow and the data points I can. But I want to make sure, the most important, that it all at the end of the day hooks to a stock call. And so every time I do a meeting, I'm leaving a meeting with, for you and your approach and your portfolio, these are the 3 ideas that I think would be most relevant for you. I think they're the best ways for you to make money. So that's the grounding that putting an investor's hat on helps with.
You're giving us ideas here to clone. So, I mean, how do you invest privately? Are you allowed to invest privately, or?
Yes, but there are restrictions. I learned this the hard way. I have a 15-year-old son who was doing a stock picking challenge at his school, and he asked me for a stock, and I said, "Well, why don't you tell me what companies, what services do you use the most?" And he thought about it. I said, "Well, I use DoorDash a lot," which of course made me go back and check my credit card statement to see, how bad it was. And but I said, well, look, DoorDash is a publicly traded company. If you use it a lot, you'll then intuitively have a good sense of whether the service is getting better or worse. Like, do you find that when you do your orders, do they come to you most often within 30 minutes? Do you find that the restaurants, the food that you want to order from is there? Are they losing restaurants? Are they adding restaurants? They've started adding in new things, like you can order from convenience stores and alcohol stores. Don't do that, son. But you can do it from, other areas. So that's what he ended up pitching DoorDash. But that's anyway, what I forgot was that meant that there was a member of my household that now owns 2 shares of DoorDash, because that's what we bought, 2 shares of DoorDash. But every time I do an interview, I have to mention that my family has a financial stake in one of the companies I'm talking about. Therefore, I have a conflict of interest because my son owns 2 shares of DoorDash. And so I made a mistake in not telling him no, don't buy the stock. Anyway, so I can buy the stocks I invest in. It's just that once I buy maybe it's a good idea to do that. I just don't buy individual stocks. I'm fully invested in the market, but I don't buy individual stocks because I just don't want to create conflicts. Because yes, I get it. If I own a bunch of Amazon, is it going to at all impact my thinking about when to downgrade Amazon? I'd be lying if it didn't at some level create some sort of conflict.
And to continue on your example with DoorDash, in the book you also give many examples of products that you or your family have bought and tested, like Stitch Fix clothes and Blue Apron meals, and you also mentioned these Snap spectacles that never got used. But how do you use those insights from your own experience and not become overconfident and rely too much on those?
Well, I'm sorry, at the very least, you need to be able to be familiar with the service so you can explain it to clients. So, yeah, I can talk usefully with clients about Stitch Fix because a lot of clients won't use the services, so I can at least explain to them, in detail how it works, when you get your clothing shipments, how good the service is. I'll just give you my own personal experience, but at least it's I think it's really important for investors and analysts to intimately know the services and the companies that they cover, which means that you'll probably never see me cover Match or Bumble, the online dating companies, because my wife would find that odd, and so I'm just not gonna cover those companies because to me it's really important that I use the service. So I do use Uber, and I also use Lyft, and I use DoorDash, and I make it a point to go on Snap, regularly. Anyway, you gotta go in there and you gotta eat the dog food in order to figure out whether it's worth it or not.
Yeah, it can be dangerous to test out the products. One of our analyst colleagues, he wanted to try out the Swedish Match products when he was researching it, and then he got hooked on the tobacco. So, but I wanted to ask you because we talked with Avner Mandelmann in episode 22 about his book, The Sleuth Investor. Are you familiar with him and the book?
No, do you recommend it?
I definitely recommend it. It's quite underfollowed. I don't think many people have read it, but he's a fascinating person, and he talks a lot about the importance of not just sitting behind your desk and doing like reading, but you actually have to go out in the real world and you have to talk to customers and suppliers and competitors and the CEO's neighbors and all those physical evidence. And he calls this sleuthing, which he see as a more structured version of Phil Fisher's scuttlebutt approach. So what do you think about this? How much are you out in the real world?
I'm looking at his book now. He's on Amazon. I absolutely agree with him. The advantage, by the way, of covering internet companies is I don't need to go outside. I can just stay right here and just spend time on the sites. So I push that with all the people I work with. I mentioned this company, Warby Parker. It's a small company, and they're top of mind to me because they had an earnings report this morning. But I went and I bought a pair of eyeglasses at Warby Parker. I went into the store and I asked the person a bunch of questions, and I tried on something and ended up buying it. I don't know if I can expense that. Should, because it's a business expense. But anyway, I did not expense it. I also then bought a pair of glasses from them online too, because they have a program where they'll send you 5 glasses and you can pick one. And I wanted to try that out. So yeah, you have to do that. And sometimes it's tough. I cover this company called First Dibs, which sells very high-end price furniture, like and jewelry and art. And it's $5,000. Okay, so that's one where I did not purchase anything on the site, but I do go and just look at it and just to see is this interesting, and can I see why a consumer would really like this service or wouldn't like it? So yeah, I think Afner's absolutely right about that.
And something you also mentioned in the book is that you conduct user surveys with consumers to understand the value proposition, right? Can you mention some example of that, how you use it?
I do that a lot. I did that with Netflix for 12 years, quarterly user surveys in the US, and we also did it in other international markets. And if you look at the data that we just, captured over the years, you saw rising satisfaction with Netflix. You saw a rising percentage of people who use Netflix. When you ask people what was the best service out there in terms of the quality or the content that you can get on streaming services, Netflix always ranked number one. By the way, then you also started to see that survey data start to mellow out or moderate in 2018 and 2019. And then what happened is COVID came and was a huge boost to the company. But you start to see that moderation prior to COVID, so I definitely use that. I use that with Amazon, and for 10 years I've asked people in an annual survey, rank order where do you shop online, and which sites are best for price, which sites are best for convenience, which price and which sites are best for selection, and we just track that over time. And I think doing a one-time survey is pretty useless, but having a series that you can look at and look at the trends over time, that is invaluable. And so it's helpful for me because I look at consumer companies, consumer tech companies, and so don't just you get your own experience, but then get that survey work, get a couple of thousand people, and then track that over time. And boy, that can be hugely insightful. That kept me as a bull on Netflix's stock, even though they went through some major disruptions. The shares did and were dislocated several times. That kept me as a bull on Netflix's stock for a good decade, and has kept me as a bull on Amazon stock for a good decade too.
It's really a good edge, I can understand. But is there any examples where you have been misled by such surveys?
Yes. And that comes with, here's a tough one. Stitch Fix was probably a call I got. Well, Stitch Fix is a call I got wrong. I wrote about it positively in the book, but and a company called Zulily is a great example of this. So here's the tough call, which is if you survey existing users of a relatively new service and you find very high satisfaction scores, great. That may well be a good if you find low satisfaction scores, okay, that's it. I'm done. But you can find high satisfaction scores. Then you have to answer some of these tougher questions of, well, how do you know that the first 3 million customers weren't the only customers? How do you know that, the early, they just won't go beyond the early adopters? And that's where the survey work can't really help you that much. There's yes, you can find that the first 3 million were happy. This is what happened with Zulily. They just had skyrocketed up to 3 million users, and then bam, they stopped there. Same thing with Stitch Fix, by the way. They got to 4 million users, and bam, they stopped there. And that's where you have to kind of draw on logic a little bit, like maybe that Venn diagram of people that are really willing to spend high retail prices for boxes of shipments of clothing to your house or your home. Maybe that's not as big as you think it is. So, yeah, I'm sorry. You can survey the current users. You can also survey people who've used the service and no longer use it. It's harder to get insights into the potential customers. That's the harder thing to do.
And the question about being an analyst, and you have to more or less have an official view on every stock you follow. And that causes, several emotional challenges, of course, which I guess you have realized many times. I've realized it as well. You have to answer for the investor base sometimes, and maybe you can have problems with company management and so on. But thinking about that, what are your most common biases?
Oh, I've made a mistake I've generally overstayed my welcome with stocks, which is actually one of the reasons I'm really glad I wrote the book, because it really helped me get out of Netflix earlier this year. And it's possible we come back to Netflix. Always stay open-minded about stocks, but yeah, I've generally ended up sticking with companies longer than I should have. That's been one of my biases.
And speaking about Netflix, and we have got into a few companies, but let's get into a few more specific companies to illustrate your teachings. Myself, I own a few of the ones that you are covering, Meta, Spotify, and Wix. And looking at the long-term drivers for these stocks, for Meta, the move to digital advertising continues. Spotify from radio to streaming, Wix from all businesses needing a digital presence, all founder-led with good or great management teams. Growth has slowed in all cases this year, but from really strong comparables. And the question is, are these companies DHQs in your view?
I think so. Let me start with Spotify. I think so. And that's also one where we've got 7 years of survey data. And we have seen Spotify gain more share on both Android and Apple devices. And it's now become the leading music streaming service on Apple phones. That wasn't the case 5 years ago or 4 years ago, but that's changed. So is it high quality? Well, it's high quality in terms of it's the global leader in music streaming, at least for now, and it emerged that way. And I think through a lot of really good product innovation too. Is it high quality? The challenge with Spotify has been, there were two major questions when they went public. Could they survive this competitive onslaught, taking on Google, Apple, Amazon, Deezer to a little extent, and Pandora to a little extent? Could they survive that competitive onslaught? Yes, they did. They gained share versus other services. The second question was, could they prove their business model? And their revenue base doubled in 4 years, but their gross margins didn't change at all. And boy, that tells you that means this business model doesn't scale. You mean your revenue doubled, but your gross margins didn't go up? Like and your even your operating margins didn't change either. Like, you've got no leverage in this business. That sucks. And people were always concerned about the fact that the labels. This is a company that had a very concentrated supplier base, like 3 music labels, account for 80% or whatever of their sales, of their revenue. That doesn't sound good. But I think we got really good evidence finally this year that when we found out from new disclosure at their investor day that their core music margins actually have expanded a couple of hundred bips. What's depressed or held in check their gross margins has been all their investments in newer areas like podcasting, which our survey work suggested probably is the right area to invest in, because that's reached a tipping point with a lot more people listening to podcasts, like us all now. Anyway, I think it is high quality. I don't think the market views it that way. I think it is. That means I've got a differentiated point of view. It means if I'm right, there's a lot of upside to the stock. And and it's definitely dislocated. The stock is trading. Where are we here? Spotify is. Where is Spotify? It's off. I don't know, 50% year to date. Am I right? But yeah, 48%. Hey, I got it right. 48% year to date. So yeah, in my book, that qualifies as dislocated. I'd put it in the DHQ camp. I do like it as a stock, and I also think there's something else here, and this goes in getting into being in the investor's mindset. If you just give me 1 minute on this, it's next play. That's the expression I talk about with everybody I work with. And it comes from a basketball coach at Duke University who, when his players would make a mistake during a game, he'd shout at them, next play. And it's, you made the mistake. We'll talk about it later. Focus on the next play. And it's the same thing with investors. Like, Spotify stock's up 50%. That means that doesn't really mean a lot to what the next move is. I mean, it tells you it's dislocated, but and we can spend a lot of time describing why this stock was down that much. But what's going to change next? Like that's one of the things I think I got out of the trap of. It's spending too much time thinking about what happened to the stock in the past, the run it's had or the fall it's had, and not thinking about what's going to happen to the stock next. And if there's something new, if there's a new catalyst, then the direction of the stock could be dramatically different, positive or negative, coming up. So anyway, that's a simple thing. It's such a trap as an investor, as an analyst, to spend time looking at what happened in the last 6 months and not thinking about what could change in the next 6 months. What's the next play on the stock? Because that's what happens in this next play is gonna help determine the outcome of the game. We already know what happened in the last quarter or the last period. Anyway, a little bit of a tangent there. Sorry.
No, really interesting. And on Meta and yeah, we can start with Meta maybe, because we got a lot of questions about that.
Yeah, I'll just stick with Meta. So we still have the two largest social media platforms in the world. Although that could change with TikTok soon, but Facebook and Instagram. You do have a high margin business, that you generate 30% plus operating margins. They generate a lot of free cash flow, which means that gives them options either to return it to shareholders, maybe for acquisitions. They certainly can invest all they want in the metaverse. So they got a lot of cash on the balance sheet, so they have a lot of financial firepower. They're still a leading asset, highly profitable business. I think this company's actually been pretty good with innovation. I like the fact that it's a founder-led company. And I think Mark Zuckerberg is one of those he's got that long-term orientation. Maybe he's completely wrong about the metaverse, but he's had pretty good product insight, vision insight in the past. I don't think that's changed. He does seem to be very long-term oriented. So to me, in many ways, there's a lot of I think the value proposition is wonderful. Sometimes we forget that, but the value proposition of Facebook and Instagram these are free services, and they're wonderful for both users and for advertisers. So high value proposition, pretty good innovation, and large market opportunities, and a founder that has made his mistakes when it comes to public relations, but not when it comes in terms of running the business, I don't think. So it's definitely into my mind of DHQ. The stock's trading at like 13, 14 times earnings. And it's one of those where the risk reward here, I think, is highly asymmetrical. Like there's just a heck of a lot of upside. They start showing revenue growth acceleration because they develop a post-privacy ad attribution model, because they better monetize Reels, their short-form video, because we get beyond this advertising recession. It's like three factors that's set up for a revenue growth acceleration. And with that business model, we get margin expansion. This thing can re-rate in a heartbeat. I don't know which quarter it is, but I think it's one of these next couple of quarters. Just like we had an unlock on Amazon stock this last quarter, I think we can have that on Facebook stock in one of the next 2 or 3 quarters. So the next play on Facebook, I think it's much more likely to have a big upwards move, and that's why I like this.
And I mean, having looked at these stocks for a while, I mean, for example, I mentioned Wix, but also, I mean, I know that you cover Shopify, and both of them are quite, I mean, some of the drivers are actually increased penetration of e-commerce, and at least my view is that part of this is quite like a temporary shift from more e-commerce to maybe more physical trading, and also, of course, with the inflation, people shop less, and I mean, part of it is actually macro driven, in my view. How do you distinguish, I mean, issues that you think are more like short-term macro-driven from the company-specific issues of these names? I mean, do you see any company-specific issues that really worries you about some of these companies?
Yeah, I do. I think there are company-specific issues. Shopify in particular, I'm not sure. I don't view that as DHQ. It could be in the future, and they've had a very innovative approach. The one thing that bothers me the most about them, I haven't outperformed on the stock, is this big move into shipping and fulfillment. And that's a real. If they can get this down, it'll be a really positive tell for that management team. But that's a very different set of competencies. They can be wonderful at software, but handling logistics and managing warehouses, like you're talking about operational logistics. That's a very different set of challenges. And I'm not sure that's the right move for them. I would think that they'd be better off doing that in partnership rather than trying to vertically integrate to do it. So, and I've been pretty public in saying that in writing that. There are assets that, like I'm very cautious of. eBay, I've had a hold or been critical of for quite some time. let's see. And I can make big distinctions within companies. I much prefer Uber to Lyft. Much greater market share, more option value in terms of international and delivery, in addition to ride sharing. So anyway.
And for the last part of every episode, we talk a bit about books because we love reading, and this is what the podcast is about. And we heard you say in your podcast with Value Walk that you are a fan of reading biographies and history, but you didn't mention some of your favorites. So can you say some titles?
A couple of the books that I think were really helpful for me in terms of investment-wise was Black Swan. Is it Niklas Nassim Taleb? What I just really appreciated about that is I think a completely accurate point of view that that there can be dramatic surprises in the future, and that you need to be prepared for them. That sounds so cliched, but we just lived through this with COVID, and so it's always like the realization that fundamental trends could turn dramatically different than what you expect, and that those who are super confident that they know the future, those people can be very dangerous. So I guess I enjoyed that. I still think Peter Lynch's book, the classic book, is a wonderful. I mean, the examples in there are a bit out of date or wouldn't be known by a good number of young readers today. But I just thought the way he approached stocks, and like there's the idea of doing your own sleuthing work. I think that is also in Lynch's book. I think that's definitely a one I would recommend too. And the other book I thought was Freakonomics. So, and this is a wonderful book with one simple example in there that always rings true to me, and that is, especially as analysts, there's such a tendency to analyze what we can find. Analyze where the data is, rather than stepping back and saying, well, if I had access to all data in the world, what would I want to find out? Rather than, hey, we've got access to this data, so let's analyze that. I think the expression in the book, or the story in the book, it's a common fable about the drunk man that you find in the alley who's looking for his lost keys, and he's looking underneath the streetlight, and somebody said, "Oh, did you lose your keys here?" And he said, "No, I lost them somewhere else." "Well, why are you looking here?" "Well, this is where the light is." And so it's just a reminder to us, like when I put together research projects and I think about what would be interesting research projects to do on an Uber and Amazon and Netflix, I say, let's step back and what would be the most interesting things to test? If I find this to be a yes, I want to be more confident about Amazon. If I find it to be a no, what are the things that we can test? And then let's see whether we can find the data or not. And by the way, if the data isn't there, or it isn't easy to get, that means our research can be even more valuable if we can come up with an answer to the question. The harder a project is, that means it's harder to find out. And we should also be humble about the conclusions that we draw, but we know that we're adding more value. So anyway, those are kind of 2 or 3 investing books or books that really help me in my thought process when it comes to being an analyst.
So Mark, thank you so much for this conversation. It's been great. And also, I mean, I learned a lot from reading your book, and I recommend it to everyone I know, and especially all investors and of course sell-side analysts. Do you have something more you want to add up before we finish up?
No, I very much appreciate the time today, Niklas and Eddie. I really enjoyed this. I loved writing the book. It was kind of a labor of love for me, and so I very much appreciate you giving me the chance to talk about it. And I'm sure that if I were to write this book again in 3 years, I'd probably have a bunch of changes to it, and that makes it exciting. So I'm always open to any feedback, but I just appreciate the chance to talk with you about it today.
Great. And where can our audience follow your work and find the book?
Well, it's available on Amazon, and it's in public bookstores. Nothing But Net, published by McGraw-Hill. And there's also an audiobook version. The movie is not yet out, though. We're negotiating the actor rights. I'm kidding about that.
And we can find you on Twitter, Facebook, TikTok, and all the other services you follow.
Yes, you actually can. But my professional opinions are just for institutional investors or clients of Evercore ISI. But yeah, the book is for everybody.
Okay, thank you, Mark.
Thank you so much.
Thank you, Niklas. Thank you, Eddie.
Thank you for listening to Investing by the Books, a podcast by Redeye. Follow us on Twitter at IB_Redeye and email us at ib.podcast@redeye.se. To improve, we'd love to hear your feedback, so please rate and review us. Notice that the content in this podcast is not and shall not be construed as investment advice. This information is meant to be informative and for general purposes only. For full disclaimer, visit redeye.se. I'm your host, Eddie Palmian, and until next time, I sincerely wish you the best of luck on your journey through life and investing.